here we are and able to be here. And as Christy said, my job is to provide a little bit of background information on what's kind of currently happening across the ecosystem of alternative investments, hopefully pique your interests and furnish those fires about things that are actually happening within the alternative investment sector, and then talk a little bit about the designation itself, the CAIA qualification that we are hopeful you are wishing to pursue, and indeed to use the Kaplan preparatory course provision courses. And Larry's great steer to help you with that. So as Christy shared, I work for the CAIA Association. We've got some 13,000 members globally. We've got 33 different kind of global chapters of professionals that represent our bodies around the world. We have members in over 100 countries now. We just had our 20th anniversary. So the growth of CAIA is pretty aligned to what's kind of happening in the alternative investments ecosystem. And we'll talk about that a little bit later, but that's our organization and indeed our mission. We have a number of roles within the CAIA group. First and foremost, we have the CAIA Charter. This is what it looks like when you've gone through both level 1 and level 2 and become a CAIA Charter holder. And that's what the digital badge looks like for you as well post your journey. We also have a group called Unify, where we put our lighter touch programs within. We have a certificate of alternative investments or fundamental of alternative investments, FAI certificate program. And there's a micro badge there. And we just launched quite recently, just a month ago, actually, we launched a digital badge looking at a micro credential around all things on the size of private debt. So some of the things that we're doing here at CAIA is building out competencies across different experiences and different understanding as well. We also have a group called FDP, or Financial Data Professional, and again, a professional qualification, looking at what therefore happens across the ecosystem of financial services. So maybe to kind of kick things off, I'd like to just spend a couple of minutes on why. Why are alternative investments something that are kind of getting a great deal more of attention and focus and interest from the world at large? I grew up in the financial services sector. I've spent most of my career working in alternative investments, and the last kind of decade's been quite tough for anybody working in private markets because we made so much money in the public markets. We did very, very well with the investment choices we made there. We didn't really kind of need to think about diversification too much. Inflation was quite low. We didn't need to look for a yield enhancement because we were getting such great returns in fixed income investments or indeed in equity investments. However, that sea has turned, that change has happened, and suddenly we've got a lot of people thinking, okay, diversification is a good thing in this increased inflationary environment we live in. Look at the cost of living for all of us, particularly back in Hong Kong and our friends in different parts of the world. We've got a whole list of things that we're thinking about and considering, and therefore diversification is something investors are thinking about, and with that comes a need to be more aware and more familiar with what's really happening in the alternative investments ecosystem. Now, there's a slew of research reports that are citing the growth of wealth, the growth of institutional investments, the appetite for pension funds, the appetite to save for the future, this migration of wealth from one generation to the other. It's all happening. It's happening in our lifetimes, and it's happening in this very, very kind of condensed and challenging market environment. But the assets under management globally are just ballooning. So the numbers here that PwC put out in a recent report just showcase how much money is in the funds management industry. And this is all in the across all asset classes. And that growth that's forecast between now and 2025 will see almost a doubling of assets in less than a decade. And we're going to see that same kind of volume of growth over the coming years in front of us. And that highlights what's going on here in the Asia Pacific quite beautifully. Unsurprisingly, we're seeing the exact same thing in alternatives. Now, again, with that backdrop, the last 10 years, 12 years post the global financial crisis, there's not been as much need, desire, or appetite to allocate, but we're seeing that growth just change. So by 2025, it's expected that we'll have an almost, again, a 70% growth in what we saw from 2020 through to 2025's growth in the alternative investments industry. And notably, that's the infrastructure area where that global growth is going to occur. We need more roads, we need more ports, we need more airports. All these things are being, we need more buildings. All these things are being built to accommodate the growth of our world, of the population, their desires, their interests. And this exponential growth is what we're seeing across the entire ecosystem. And perhaps closer to home, the passion for us within Asia and our interest for the alternative investments industry is really mirrored again in the numbers. I mean, look at that growth from 04 to 012. You know, kind of a little bit kind of went on. There's a sevenfold growth there, but look at what's happened that next kind of 10 years between 2012 through to the expectations of 2020 and now indeed 2025. And again, that's being driven by infrastructure, and that's also being driven by what we're seeing across all things in the private equity space as well. So again, massive growth, massive interest, massive appetite for the alternative investments industry, arguably meaning that we need to be a bit more informed, a bit more familiar, a bit more aware of what kind of happens in this ecosystem of investment. And looking at this, we're going to see a widening in the investor groups. We're going to see a doubling of the investments across the ecosystems of infrastructure between 2022 and that forecast of 2027. So again, this significant trajectory of growth and change, appetite and investment across the world. Private capital is the term that we're hearing so much about. That's kind of all things alternative, bar hedge funds and bar some of the structured products. But the 6 sectors that make up private capital, private equity, private debt, venture capital, real estate, infrastructure, and natural resources, those 6 areas are growing to the point that has surprised so many. The banks stopped lending a while back, and with the restrictions and the problems we've seen happen quite recently in the banking space around the world, the banks are getting more and more hesitant to lend and to be actively seen to be lending money without kind of due care and due restrictions being followed. So access to private debt and private investments has never been greater. And again, with the current trends and the regulatory controls that we see, we're going to continue to see this growth. So it's a very exciting part of the industry to be looking at, as far again as that private equity and that venture capital space. What that means for us here in Asia is this phenomenal CAGR compared to the North American, compared to EMEA, and compared to what's happening in other parts of the world. What you're seeing here is this phenomenal CAGR of growth that's expected, with appetite and investment and allocation really taking part of what's happening across the entire ecosystem. When we think about where the money is being made, the actual GPs, the people that run the money, the general partners, the asset management groups, as of the end of 2021, about 17% of all assets were being allocated to alternative investments, and that made almost 44% of the profits that those GPs or those fund management groups are actually enjoying. But as you see here, with that growth that we're forecasting, by 2026, about a fifth of all assets globally will be alternative managed by nature. But, and importantly, they're going to deliver more than half of the income that the actual banks and the asset management groups and the GPs therefore enjoy. So there's no surprise that we're seeing this change in how businesses are run, and people are kind of trying to capture what's happening here in the alternative investment space as well. And what's stimulating this growth? It's really the choice between what's happening in the public market space and what's happening in the private market space. It's the new economy, the world in which we live in, has really gone private. Companies are choosing to stay private for longer. So I love this bar, these kind of pie charts on the right-hand side here, a group called the Thinking Ahead Institute, a research think tank, part of WTW, the asset consultant. They looked at the public to private ratio of cash that was raised by names that we're very familiar with: Google, Facebook, and Uber. So top right there, Google raised just $25 million from friends and family private investments before they chose to go public. And at which point, Google made $1.9 billion of value in the public space. Looking at Facebook, they raised $2.4 billion privately. So friends, families, family offices, connections, small organizations, etc., backed Facebook rather than that coming in via stocks and share trading market. When Facebook went public, $16 billion of cash was realized at that particular point. That kind of public to private ratio has come down 90% from 76 times when you look at the public to private ratio of cash raised at the IPO versus private for Google to 6.7 times for Facebook. They took on $2.4 billion privately and some $16 billion within the public space. But look at Uber. They raised $22 billion from friends and families and connections privately. And then when they launched, all that juice, all that money, all that enjoyment had been realized in that private space rather than that $8.1 billion of cash that was raised at IPO, a 0.4 times public to private ratio. So it's quite clear. And again, here on the left-hand side, Slack, Facebook, Uber, Twitter, all of this growth, all of this value has been enjoyed in the private space. Less restrictions, less regulatory controls, less kind of controls, period, but being aligned with investors that follow and seek and wish to support. So this growth is being simulated by the fact that companies are just choosing not to go public and wishing to stay private for as long as they possibly can. When we think about Asia, we really think about this chart from a CAIA perspective, which is this, the GDP per capita. This was published in March of 2017. It's a little bit old, but it's still something which I think about. Remember, like opening the Financial Times newspaper and seeing this, like going like, my gosh, what's going on here? And so we think about the 19th century being the British Imperials kind of opportunity for growth and chances. The 20th century is really about the American. The 21st century is really about Asia. And I think about this as kind of across 4 different quadrants. Firstly, we look about the millennials. We've got 8 or more than 800 million millennials across Asia versus just 66 million across the Americas and just 60 million across Europe. There's a passion, a desire, a belief that therefore most of those in Asia will be better off than their parents. Whereas in the West, a lot of wealth has already been made. A lot of the kids there don't see themselves being as successful or as financially successful as their parents are. We have a complete and utter difference in how the market is being worked here in Asia. There's a very strong work ethic and entrepreneurial spirit that sits within the Asian ecosystem as well. That too is going to drive growth and drive opportunity. And that middle class, yes, the world over, there's many middle class professionals or people that are therefore being made into that kind of category. But of the next 10 million people on our planet that will have a middle class consumption status, 9 million will be here in Asia. So again, this phenomenal growth engine, this kind of things that are therefore positioning the opportunity and that fire for things ahead. So in 2025, APAC's consumer spending will be bigger than the rest of the world combined. And those numbers just astound me. I mean, they completely astound me when I think about the impact of those things. So millennial, middle class, and the other 2 is metropolitan and mobile. So metropolitan, we have over 300 cities across Asia where the population is more than 1 million people. There's 10 in the States, there's 18 in Europe. So these massive high density populations are going to provide some amazing opportunities for public companies and for companies to therefore kind of come out and do different things. The VC world has seen nothing yet when we think about what's going to happen here in Asia. And the mobile enlightenment, the mobile positioning is also something we have to be thinking about. We've got over 4 billion phone subscribers, over 2 billion internet users. Again, that interconnectivity, collaboration and connection will really fund that fire of innovation as well. So some phenomenal things going to happen globally within the alternative investments world. And more regionally, we're going to see some phenomenal things happen across the Asia Pacific as well, which if you've not heard my voice, I'm actually rather excited about. There's a lot of good stuff that's going on. So with that as your backdrop, why CAIA? Why are we thinking about professional qualifications? Why are we thinking about things differently? As I shared, our mission, our call to action as an organization at CAIA is to improve investment principles. We think the investor should come first. In order to serve our investors, in order to serve our clients, we need to be better informed, better versed, better understanding of what's happening in the ecosystem of investments to provide better advice and better steer and better protection to the things that we're doing. And therefore, as this rapid environment continues to kind of take shape and progress and move, we need to be better ready to have those conversations and those discussions. And that's where really the CAIA qualification can make you better professionals, help you with showcasing your experiences, and need to help you with differentiating your skill sets as well. We spoke about the members and our reach, and we spoke about those sections there. In addition to the qualification within the CAIA family, we have a whole raft of research and content and white papers. And with Krista's blessing, we'll share some of these with you in case these things are helpful to you, to be a little bit more aware of, or at least having a radar, and subscribe to those newsletters and subscribe to those news wires too, if they're helpful to you. So as we said, when we think about what CAIA does, it allows you to therefore distinguish yourself. I think more and more professionals are having to provide advice across the entire risk return spectrum, and therefore getting kind of ready to have those discussions, being relevant, being current, providing flexibility and so forth is really, really important. And therefore, from an alternative investments knowledge perspective, CAIA would help you with all those things. The curriculum itself has been based across two levels, level 1 and level 2. We look at real practical industry relevant items that have developed and evolved. We have a whole slew of academic research that helps you with the knowledge around all things relating to alternative investments. In level 1, we look at ethics. We look at the introduction to alternative investments, and we dive into real assets, private securities, hedge funds, and structured products. I like to think about level 1 about being the what of alternative investments, the principles behind the things that make alternative investments work. The exam at level 1 is all multiple choice, 2 2-hour papers of 100 questions. This really kind of tests you on the what. What are alternative investments? What is a hedge fund? What's a private equity fund, etc., etc. And after level 1 comes level 2. I kind of think that as being the how of alternative investments. We look at ethics, we look at models, we look at how institutional investors look at investments, we look at policies, due diligence, risk management, all these different areas of items about the application of investments into the alternative investments industry. And so level 2 is a 2-level exam. Paper 1 is multiple choice, and paper 2 for level 2 is a constructed response. So again, 2 levels, level 1, 2 papers, all multiple choice. Level 2, 2 papers, 1 paper is multiple choice, and 1 is those constructed response questions. When we think about what happens post going through the CAIA journey and going through the CAIA program, we look at a number of areas that think about how we as professionals can work in the principles of what's actually happening within the alternative investments industry. And again, I'll share the copy of this research with you, again with Krista's blessing, about why and how we think portfolios of the future are going to be managed under this piece of research called Portfolio for the Future. When we think about the CAIA program too, we have a whole slew of sources and research and readings and curriculum that sits on our platform. And again, this is where the Kaplan preparatory course provision, directed by Larry, and the materials provided by Kaplan can help you. There's a whole bunch of materials we provide for our candidates, but we know that the success for many candidates needs to have a bit more training or a bit more assistance. This is really where that digital learning and assistance that Kaplan can provide you is really worthwhile to be thinking about. As we think about what therefore happens, what we feel occurs to those professionals that have their CAIA designation is you can advance your career, you can have that relevant knowledge and build those building blocks to be able to run money efficiently and be prepared to meet the demands of your clients in the future. Cost-wise, the exams have an enrollment fee of $400, and then there's an exam registration fee. We are in that early bird window right now. So for right now, that early bird at $400 plus $995 for the exams will take you back to $1395 to sit the exam for level 1, and the fees there for level 2, and the retakes are noted as well. Dates for your diary: the early bird registration will expire on the 5th of June, after which your exam fees go up to $1395. And then exam registration closes for the September exam window on August the 14th. If you're thinking about sitting exam level 1, that time is between the 4th of September and the 15th of September of this year, to have those dates in your diary. After you pass the exams, you become a member. They're the fees to maintain your membership and have those things in your mind. And who are our members? That those 13,000 people around the world work for banks, consultants, fund managers, the big asset owners, the big regulators. I'm sure brands here that you're very familiar with, where our members are currently employed, where they take their skills and their work. So again, thinking about membership, giving the different areas of visibility and engagement and understanding. That's the CAIA program and the CAIA curriculum. I will pause there, and recognizing that we've spoken about the industry as a whole, why the opportunity set for all things alternative is growing quite so exponentially right now, the CAIA program itself, and the fact that we know for many, working with a preparatory course provider to help you on your journey is really important. And therefore I will pause and see if there are any questions. Kirsty, may I stop there and ask the questions at this point?
Yeah, do you have any questions for Joe? And for those who join us through Zoom, if you want to ask any question from Joe, you can just unmute yourself, or you can type in the chat box.
Hey, that's great, Christy. Thank you.
How many CAIA members are there in Hong Kong?
Joe, we've got a question for you, and participant would like to know how many CAIA members in Hong Kong. Do you have the figures?
Yeah, we do. So we have, Hong Kong is CAIA's biggest membership in Asia. So we have, of that 13,000 members, or it's almost 14,000 now members globally, about half of those are across the Americas, and about a third of the balance are across Asia. We don't disclose market by market members, but we have the biggest number of members for CAIA in APAC is in Hong Kong, closely followed by Singapore, and there's always this kind of tension between the growth between the two markets. And then Korea is a very significant market for us as well, as is here in Australia. And then India, China, Japan equally have members that we're working with. But globally, about a third of our members are across Asia, and Hong Kong is the biggest portion of members at the moment.
Thank you. Any other questions? Okay, if there's no other questions at the moment, please let me to thanks Joe again for your participation, and we'd love to see you in Hong Kong soon.
Absolutely. I fly back. Well, Hong Kong's my home. I can't wait to come home on Friday. It's a pleasure to be here, Christy, as ever. Thank you. I wish the rest of your session success. As I say, To those in the room and those on the phone, I shared my contact details before. Do reach out and do connect. I'm very excited about the alternative investments industry. I think you're taking the right step to think about your qualifications and your competency. And you're in very, very safe hands with our partners at Kaplan. They are the longest serving partner of CAIA globally. And the work with Christy and Larry here in Hong Kong has always been a complete pleasure. So if you're thinking about your program, best of luck. And if I can help at all from CAIA's perspective, let me know. But great to be here this evening. Thanks for the invitation.
Thank you. Joe, before you left, we've got one more question for you.
Oh, sorry. Yeah. Okay, sure.
I want to just a rough estimation. What's the average passing rate?
You mean in Kaplan?
People who takes paper one, roughly CAIA, how many people pass?
The participant is asking the passing rates, but we've got for level 1, as I know, there's a 49% around average. This is the yes. Maybe the participant is a bit worried about the low passing rates. Do you have any advice, especially for level 1?
Say that's a low. Yeah, I would say that's a low passing rate. I think it's you're absolutely right, Chris. It's kind of like 49 to 50% that we typically see as being the passing rate. I think truthfully, when I chat to those candidates that pass, they're prepared and they put the time and the effort in. They've done their research, they've done their reading, they've asked questions where they need to kind of get some help. So I think in order to prepare yourself for success and to pass the exam is about being prepared, and it is about therefore reading the curriculum, working on the questions, and then arguably if there are areas where you need some help, it's working with people like Kaplan to help you on that journey. So it really is about being prepared. And again, anecdotally, we did the research on our candidates globally, and those that commit early in the exam cycle have a much higher likelihood of passing. And I think that's just because they've committed to doing something, the research and the time, they've signed up for the exam, they've bought the prep courses, etc., and they're studying. So I wouldn't be too worried about the pass rates, truthfully. I think it's really about committing to the research, committing to the reading, and committing to the lessons that you need to walk through to be prepared for the exam. So give yourself the best chance to be ready for the exam, and you'll be fine.
Yes, and that's why we provide our exam prep course, just want to enhance your chance to pass the exam.
Exactly right. Seriously, a lot of work goes in. So there you go.
We can get back to you after the job. Yes, because there's a statistic indicating their website. Yes. Okay. Thank you very much for your time, Joe. Thank you.
Thank you to those in the room and to those on the phones. Thank you very much, Christy and Larry. Thank you. A couple of hours here in front of in Sydney, so I'll say good night and leave you guys there. But again, you have my contact details. Do please get in touch. If I can help, my team can help, we'll be delighted to. But again, enjoy the rest of your evening. Happy Wednesday, and again, thank you very much
Joe.
indeed.
Thank you.
God bless. Take care. Thank you.
Bye.
Bye. Bye.
係啊，等先啊，OK，好，slides. Okay, and now this is the time. Let me pass to our trainer Larry, and he will continue to give a demo lecture. In case if you have any questions after his presentation, we can wait for another Q&A sections. Thank you, Larry.
Okay, so first of all, welcome all to join this demo lectures tonight. So my name is Larry Yuen. I'm the full-time lecturer at Kaplan here, and responsible for both this CAIA courses and also the CFA courses as well. Okay, and hopefully I can make use of my previous experience in the banking, asset management, and private banking. And knowledge, to help all of you, to prepare for examinations. So what I'm going to do for the rest might be 15 minutes, right? Hopefully, after Joe's presentation, I think we all got a very good ideas about these alternative investments, and also the organizations, CAIA, right? It provides us this curriculum, the examinations, so that the candidates can gain the knowledge and prepare themselves for the job, serve the clients better, and also for the future. So what I would like to do is focus more on the examination structures, the content, and what we can do about to help you to pass the exam. So here just the background information, and I think Joe talked about it already, but here we look at it from a different angle. Yeah, because Joe, according to the presentation material, you see that there's tremendous growth potential still. Yeah, on the alternative investment market. Yeah, so the market grows. What is happening behind, and we can look at it from the demand and supply angle. And here you can see, in terms of the demand, there will be more investors that they are in need to invest in the AI, the alternative investments, corporates, pensions, insurance companies. So all this, right? And I think that is more. Particularly in the past couple of years, that the traditional market has been a bit volatile, and the traditional portfolio, like we used to have this 60-40 portfolio split between the equities and fixed income, and but that kind of a portfolio seems to be not working in the past couple of months, no, the past couple of years, right? And also the low interest rates for a long time until last year, right? Until last year, these different governments, central banks start to hike rates again. But then, before then, there was still a very low interest rate environment. That makes the fixed income investments is very difficult to work. And sometimes they also just end up with a negative interest rate. So all this end up with a stronger demands for alternative investments, right? Yeah. So for this demand, of course, there are supply, right? We have supply, we have more iBank, we have more private bank, and we have more structural. They come up with different kinds of products, structured products, products that can help investors to invest in the private markets. And well, as Joe mentioned, that the private market is one of the components of the AI that has the greatest growth rate in the past few years. And also the government has pushed out a lot of these infrastructure projects that can be financed by the private sectors as well. So all these are the supply of these investment opportunities we see in the markets. So with all this demand, supply, getting momentum, I think that is another way to echo our view that the alternative investments market is going to continue to grow. Okay, so these are the figures. So I don't have to spend more time on this, I think. So let me just jump to the examinations content. This is the level 1, right? Level 1, we got this standards, ethics. Well, basically, these are the guidelines, the rules that we are expected to comply with, right, in the industry as a professional. Well, as a professional, investment professional, there's no difference between the CFA Institute member or the CAIA member. So all investment professional are expected to comply with this standards and ethics formulated by the CFA Institutes, right? And on top of this, we got the introductions to AI. So what is it? Again, it is not particular for alternative investments only. It also applies to traditional investments. We are going to talk about, of course, the characteristic of the alternative first, and then we'll move on to talk about the different kind of measurement of returns and risks, right? And also different kinds of a little bit of a modeling, yeah, as to, for example, how do we model this fixed income product value, statistics. For example, some hypothesis testings, some regressions analysis, all these are the foundations, right? no matter we're talking about alternative investments or traditional investments, they all apply. But the thing is, they apply more in certain areas for some products than the others. So we have to be prepared, to be very discerning, in which case, in which area, in which product, how do we assess this return, different return and different risk measures. And then we'll move on to the 4 major components of the AI, which is the real assets, private equities, hedge funds, and structured products. And this is how CAIA define the AI. Well, honestly, there's no fixed and fast rule how to define alternatives. But these are the 4 major categories under the CAIA definitions. So we're going through each of these to understand what they are, how they make money, how can we invest in these different types of AI, just like what type of products that are available in the markets, and how do we assess these different products. Okay, so having gone through all this, these are it's kind of a building blocks, right? We know the building blocks is just very essential to come up with an alternative investment portfolio. So when we move on to level 2, there will be other areas that we have to take care of. How to put all these different building blocks together. We are going to talk more about the models, the risks, like the interest rate risk, the credit risk. And when we assess the products, that is a very practical issue, right? When we look at the fund, we don't just look at the figures. Not just about the historical performance. There will be a lot of things to do. And we call it due diligence, right? And some others, volatilities and complex strategies that we are going to cover as well at level 2. All right, so level 1 is like the building block, and level 2 you put all these different things together, and also you have to consider some practical issues, right? Like your clients might be institutional clients, might be private clients. How do they do their asset allocations, and how we can help them? When we help them, how do we do the modeling? Different kind of risk measurements that we have to apply. So that is about level 2. All right, so these are the costs. This is the passing rate. If you are concerned, it's pretty steady, right? As you can see in this graph, right? Level 1 around 50%, and level 2 is slightly higher. However, I always think that we should be taking this just as a reference. Just a reference, like a 50% passing rate. It is on average over so many different candidates, right? It is not telling us that you have a 50% chance to pass. Okay, you might have a higher chance or lower chance, right? Just like Joe, well, I like the way that she responds, right? Well, actually, that is, well, in your hands, you have the control. It depends on how much commitment that you can devote to the preparation to this exam. Okay, of course, sometimes it depends on the background, right? If you have a relevant background, of course, it helps. It would enhance your passing rate, potential passing rate. But after all, it depends on how you prepare for it. And according to, again, it is statistics in the past, for those that they have gone through these examinations, usually they spend at least 200 hours to prepare for it, at least, right? So you can just imagine, right? 200 hours, how can you spread this 200 hours over might be 2-3 months? And how many hours that you have to commit, each week, to prepare for the examinations, right? So if you have the commitment, if you have the resources, and if you learn the things in the right way, then your passing rate could be higher than the average. Okay, so how we here at Kaplan help our students to prepare the exam, right? According to our experience, right, there are 2 things that we should bear in mind. For these examinations, the first thing is there are quite a lot of things. I mean, quite a lot of topics and issues that we are going to learn. So the volume the volume of the syllabus of the curriculum. We should have we should bear that in mind. And the next thing is, students usually discuss with me and ask whether it's very quantitative examinations. With the questions ask us to do a lot of calculations, that kind of things, right? And well, usually no, right? Usually no, right? According to the official figures, right, it should be just about 30% or even less than 30%. Okay, but we have to understand all these different theories, concepts, and that is how we try to help our students to expedite their study. There's so many things. The volume is so much, right? We try to focus on the key things and explain the concept, the theories in a less technical terms, so that it is easier to understand, to digest, and to apply. And that is what we mean here, to expedite our student study, to conquer the volume, to understand the concepts, and then apply to the exam questions. So how do we do it? We have this face-to-face classes, and supplemented by some of these video recordings. We also provide some course materials in addition to the official curriculum that you should have, right, when you register for the examinations. So hopefully we can provide you with some precise and concise materials to help you to do the study. And lastly, there will be a mock exam for you, to check yourself and see whether we are ready for the exam. Okay, and here I want to show you just a few slides that we used in the classes, and just to demonstrate how do we deliver, to make these topics to be more easier for the students to understand and tackle the questions. First, I extract this from the curriculum, right? You remember for level 1, there is a section is the introductions to alternative investments, and this is one of the topics within that. And this is about the risk and the performance measurement. And one of the risks, when we do investments, the risk saying that maybe we are very concerned as to how much money that I might lose, right? Well, that is an amount in dollar terms, right? That is one measure, and there are so many other measures, and in the curriculum, there's a measure called VAR, value at risk, okay, and we're going to look at it. How are we going to work out the value at risk? And there are different approach, parametrics, and based on the historical data, and we can do some Monte Carlo simulations. Okay, so there are two things here. The first is, if it is parametric, we might need to do some calculations. If it is not parametric, there are other ways to work it out. The calculations were unlikely to be asked in the exam. But we need to know, what are the other methods to work out this number. Okay, now let's take a look. Firstly, it's a parametric way of doing this. And the risk, value at risk, that's like the losses, potential losses. Potential losses here are linked to the probabilities. What is the probabilities that I might lose that amount of money? Basically, that is what it is, right? The probabilities that I might lose that amount of money. So we are going to, first of all, we have to specify, right? Over what time period? Is it in a day or in a month or in a year? And then what is the probabilities? Then we can work out this potential loss. And then we apply a probability distribution concept here, right? For those students that they have not studied the statistics before, maybe we just look at this. We call it a normal distribution, but for the time being, we don't talk about normal distribution. We just say that, right? This tells us the probabilities of all the potential outcome. sometimes, yeah, we gain a lot of money. Sometimes we lose a lot of money, right? But most of the time, might be we just about average, right? Okay. In other words, we have very high probabilities around here. Yeah, that is the peak of this curve. But, well, sometimes we make big money, but the probability is pretty low. And also, sometimes we might lose quite a lot, significantly, but the probability is also very low. So, with these probability distributions, okay, and the distributions will tell us with this amount of probabilities, let's say 95% here. 95, what does it mean, 95? 95 means the whole area under this curve accounts for 100% because it accounts for all the potential outcomes. Yeah. So here we say that 95% of the potential outcomes will be to the right-hand side of this figure. And 5% of the potential outcome or the probabilities is on that side. So in other words, we have 95% confidence that our outcome will be at least equal or greater than that value. Or we can say that there's a 5% chance that our loss will be at least that amount. Okay, so there are two ways to tell our clients about the loss, right? It's depending on which way that you look at it, and that is called the value at risk. And we can work it out parametric, and we just have to follow the equation. The equations basically depends on this probabilities distribution. And with this probability distributions, if you want to work out this VAR, we need to find out the distance of the VAR from the average. The mean is the average. And this distance is represented by number of standard deviation from mean. So the distance from the mean. Okay. So we are going to work out the number of standard deviation. Again, the standard deviation is the concept under statistics. Okay. If you know that, okay, it's easier, then we'll move faster. If the students, okay, I don't know what is it. So we have to spend a bit more time on this. But anyway, here, today we just look at this. This is the calculation part. Okay. And these calculations will tell us, well, in percentage, you might lose 10%, 20% according to these equations. If you want to turn it into dollar value, you have to times the VAR in percentage terms with the portfolio value. Okay, so all this parametric is based on these normal distributions. Okay, this is an example. So in the class, we'll go through this example, various kind of examples, and put all the things together to work out the answer. So in terms of the calculation, as you can see, it is not rocket science. Okay, but we have to understand the individual component. What do this mean? Why do we put them all together to get this? Okay, so that is the most important bit. All right, so, and also we'll talk about these correlations, right? When we put different things together in a portfolio, here is two identical assets. I just want to demonstrate the risk. The risk if they are, that is perfectly correlated, perfectly positively correlated. So your risk will be just the sum of the individual risks. Okay. So when we talk about portfolio, of course, we have to mention the concept of diversification. If there are some diversification, that means the investments in the portfolio are not perfectly positively correlated. If they are not perfectly positively correlated, okay, so you can see the VAR, here, this, these are, well, lower. You have lower risk when your correlation is less than 1. Yeah, and you have low risk at all. If you can find two assets which are here is perfectly negatively correlated, right? So it is, well, great job, right? If you can find two investments that they have perfectly negatively correlations, yeah, we can reduce the risk and still have the return, and we call it the riskless return. Okay, so that is one thing. The other thing is similarly, yeah, when we talk about the structured products or some of the hedge fund strategies, yeah, we will talk about some of the derivatives like options. Yeah, options, okay, we have to understand how it works, but we don't have to do a lot of calculations, right? The calculation part is out of the curriculum, okay? So, but we have to understand what might affect the options and how we can make use of the option. For example, if we buy an option, we call it a long. Yeah, we buy a call options. That means when we exercise the call options, we can buy these underlying investments at the strike price. So the strike price is to be determined. And in order to have these options, we pay a premium. That is the price we pay, right? We pay this price in order to enjoy this. This is the upside, okay? Okay, okay. But there's no downside. So if the share price does not go up, I don't exercise my call option. I have no further loss. Okay, that is about the options, and you can think similarly. That is short. I sell a call options. Yeah, I earn the premium. But if the share goes up, yeah, I am suffer. Yeah, that is the payoff. Yeah, to the option holders. And on the other hand is the put. The put gives us the right to sell at the strike price. It is a predetermined price, okay? So when we pay the price, okay, in case the share price goes this way, that means the share price drops. Yeah, I have the upside. And similarly, yeah, if I sell these put options, I have the premium, but if the share price goes down, I have to pay off the put option holders. So once that we understand these building blocks, we put them together. Yeah, we have to understand how we put them together to have the desired effect. And for example, one of the strategy is called cover call. Cover call is like I hold this, I long the underlying. That means I have the shares. But at the same time, I short a call. Yeah, why do I short the call? Because I don't think the share price will go up further. Yeah, so it's like here. Yeah, that is what I expect. And I don't think the share price will go up further. So if that's the case, what I get is the additional premium by shorting the call. Yeah, so enhance my return. So that is what I mean. Once that we understand how this put, call, long, short, then we put them together to have the desired effect. And also, these are the other examples that we'll go through in the classes. And also, yeah, we have various questions again. Yeah, when we finish talking about certain theories, concepts, we do some questions in the class. Okay. So that is how we conduct the class. And then after all the classes, there will be a mock exam, yeah, for the students. Yeah. All right, so that is all I have prepared for today. Yeah, and for the time being, I pass it back to my colleague, Christy. Yeah, she will go through all these different product offerings. And I will stay behind. If you have any questions, just feel free to ask.